Hello and welcome to UCI BL Applied Innovations VC Speaker Series, our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and resources that will help entrepreneurs and founders navigate in the current crisis and thrive in the upcoming recovery. So for today's webinar, we're very pleased to have with us Sanjay Reddy, partner at Unlock Venture Partners. Sanjay has a great background. I think you'll enjoy the conversation and everyone should learn a lot. But before we begin, I'd like to thank, as always, our sponsor, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide. Kenobi Martins has close to 275 lawyers and scientists and dedicates its practice to all aspects of intellectual property and technology law, including litigation. The firm is headquartered in Orange County, and we're very fortunate at UCI BL Applied Innovation to have Kenobi as strong supporters of our mission and of the VC Speaker Series. More information about the firm can be found at www.kenobi.com. So for a few details right now about the webinar. So unlike regular Zoom meetings, you can't unmute yourself and you can't turn on your video. So if you have a question, please type your question in the Q&A box. So not in the chat box, use the Q&A box. I'll moderate and ask those questions throughout our discussion or at the end. So after our discussion portion of the webinar ends, right around noon or a little before, we're going to keep the Zoom webinar open so Sanjay and I can type answers into the Q&A box. So if your question doesn't get answered live, hang around with the Q&A box open and we'll try to answer some of your questions privately. Okay, so with that, Sanjay, I'd like to join you to the webinar. There you are. Good to see you.
Good to see you too, Luis.
Good, good. Sound volume sounds a little light there, but we'll play that one by ear. Listen, I'm looking forward to our conversation. You and your team have you've built a great firm, and from everything I can tell, every time I've dealt with you guys and been to a number of your events, you guys have a great network too. So I'm eager to kind of see what we can get from that. But before we go into that, I like to have our audience kind of get to know you a little bit. So why don't you give us a little bit about your background? Where'd you come from? Where'd you grow up?
Sure. First, thanks, Luis. Appreciate, we've always had great interactions, and I appreciate sort of our ongoing relationship. And thanks also to UCIBL for allowing me and Unlock to share some time with you and talk a little bit about what we've done, and hopefully, help your audience with some information that might be useful to them as they move forward. So the origin story, as far as I go, I was born and raised in India. I came here after high school. I came here for college back east. And then, I always laugh when I look at some of the kids that I work with, kids, yeah. As you get older, you can say that. The kids I work with who seem to have their careers plotted out for 20, 30 years. I had deferred admission to business school in a couple of years. So I figured, I was done with, for someone who grew up 22.5 degrees north of the equator, upstate New York gets kind of challenging by year 4. So I figured I'd go to LA, where, people watching the Rose Bowl in their shorts on New Year's Day. And that's the true story. I came out here, wound up, doing a couple of different things. Spent some time in the entertainment business. Actually, my first startup was in that space, in the independent record business, where I learned firsthand the challenges of working capital and being underfunded and constantly having to plow business money back into the business. So my first instance of startup life, and thereafter I switched and went to business school. I was at Anderson here at UCLA, and then switched up and decided to go back east and be an M&A banker at Solomon. So, very, very 180-ish.
Yes, certainly from obviously from East Coast to West Coast, and then kind of working in industry and doing some startups there at business school, then back to East Coast for investment banking. So that's kind of after investment banking is when things really started to get interesting. So why don't we dive into those companies, what you did after investment banking, and the kind of your path from industry to founder to industry, et cetera.
Yeah, I think it's an interesting thing, and I think we'll see more of that in the times as times have changed, and I think career paths and life cycles for careers in one company or even one industry are going to get compressed just given the rate of change. But so I never wanted to be a lifelong investment banker. So I actually switched and I went to Covad, which is a publicly traded DSL company in Santa Clara. So
Okay.
I moved back to the West Coast, but I wanted to work in technology and get that under my belt, but really with a more, not like a dot-com, more an industrial type of technology company. So I did that. Got recruited back by Solomon here in LA. So I did a bunch of stuff, a bunch of restructuring. Come in doing cross-border M&A with an $8 billion public company. That I was there for some of that, and then I experienced firsthand, the crash, so to speak, in '01.
Mm-hmm.
Oh, in 2000, well, 2000 really, and then the aftermarket. And the interesting part was, I did a bunch of restructuring work, the best deal work I've ever done. It didn't matter to me because, I was looking at his experience, but I got recruited back by Solomon, moved back to LA, which is where I always wanted to be. So I've been here in LA since 2001. Again, and this is where, I love LA and definitely wanted to live here. And then I did a few things. I'll skip through it. There's no need to go through a full diatribe, but I worked, you come back and then after Solomon, I wanted to do a startup. It was a little bit, I'll call it the unintentional. We've talked about this, the unintentional versus the intentional entrepreneur. So that one was a little bit intentional. We wanted to do outsource 2 and 3D animation to India and take a software business and take it up one notch, not just do, software services, but like take it up one level in terms of animation, and then use some of the bench strength from the division to create O&O IP. It was a bit difficult. We wanted to buy an entity because we didn't want to start from scratch, and that had its unique challenges, but we wound up buying a division, but it's wound up getting stuck in the software piece, which was not really very interesting to me. So I got recruited in the meantime. I got recruited to be chief strategy officer at Jumpstart TV Guide.
Mm-hmm.
So I was there. Well, I started off, in that division, took over the group. I was there from '04 to '08, and I ran the sale. It was a turnaround. I ran the sale when we sold it, and did a public auction, merged it with Macrovision, and became Rovi.
Right. So yeah, I mean, that's back then, Jumpstar, that was Jumpstart TV Guide. I mean, that was kind of right. That was an interesting time for them, and also kind of got you exposure. You had animation exposure, then probably got you some television exposure as well, right?
Yeah, so I mean, Jumpstart was at the intersection of really true intersection of media and technology. It was a very interesting company. It had B2B
Mm-hmm.
because they were licensing IP and software products to the cable television, as well as the cable and satellite, as well as the CE businesses. But at the same time, we also had TV Guide channel, the TV Guide magazine. We had TVG, the horse racing network. So
Oh.
it was very, and News Corp owned 41% of the company, even though it was a public entity. So very much at the intersection of the two worlds. And if you think about where we are today, that was an interesting sort of opening sequence to what we've seen unfold.
Right, exactly. I mean, I think at the time you guys were probably envisioning this streaming future, but yeah, who knows? Yeah, it was obviously still a ways to go, and Gemstar wasn't able to kind of maybe get there.
Yeah. And I think thereafter we sold, we left, and then we're thinking about a few things. And I wound up partnering with a serial entrepreneur named Nova Spivak to create Live Matrix, which is a guide to the live web. Early days, so we saw where the web would be. Flash forward today, it is the web. Anyway, I merged that entity. I merged that entity with a venture funded startup here in LA called OV Guide, and we ran that the combined entity, and then sold that ultimately to an OTT company.
Okay.
Before starting Unlock.
Yeah. So from industry to startups, back to industry, sold that, kind of ended up back to the startups. So yeah, you've certainly seen the lifespan, I think, directly experience the lifespan of what some startups go through. And now, was that last one, was that intentional founder or unintentional founder?
A little bit of both.
A little bit of both on that one. Okay.
A little bit of both. I mean, it was intentional in terms of doing it, but I think it was not, it's not like I was sitting there thinking, okay, I've been thinking about this idea for a year, and I'm going to do this at this particular period of time. But having said that, it was intentional in terms of doing it.
Got it. Got it. Okay. So, so this whole time you're also making angel investments, right? So
Yeah.
that kind of got you a little bit onto the investing side.
Yeah, well, I've always been, when I tell you the origin story of Unlock, you'll kind of get that. But yeah, I used to write. Angel investing, very different. I was not a super prolific angel, but I was very targeted. I have a pretty high hit rate in terms of angel investing. For instance, I was invested in Clout. I was invested in JW Player, and Netcracker. Those are three great outcomes with great returns. But I look at my angel hurdle, even though I'm relatively financially adept. My hurdle is very simple. Is there a high likelihood I get my money back?
Okay.
If so, I don't think about 10x, 2x, 15x, and all of that stuff, because my hurdle rate is what, 30, 40 basis points by holding the cash in the bank. And so that was a different prism through which I looked at it. But yes, we did do a bunch of deals.
Okay.
As a collective,
Cool. All right.
we're very prolific, done about 130 angel deals prior to venture investing.
Wow. No, that is prolific. So it probably the number of deals is indirectly related to your hurdle rate, right? Lower hurdle, more deals, I guess. Then that may not apply to your hurdle rate for Unlock Venture Partners, though. So let's be very clear about that. And why don't you tell us about Unlock? So how did Unlock? When did it come together? How did it come together?
Yeah, so actually, I take it back to Gemstar. So
okay.
One of the things that we did at Gemstar, this was the early days when we were trying to figure out what was going on. We had a couple of digital properties associated with our media assets. And so it was the notion of how do we get more intelligent around it. And one of the entrepreneurs who came in, we were introduced to through our then CFO, was Andy Liu, who's my current partner at Unlock. So Andy was on his second startup and second venture funded startup, and he came to us with this idea for Buddy TV, which was, if you think about all the companion television apps and all the things that are happening now during the pandemic, that was what Buddy TV was way back then. And so we thought it was really interesting, and I led his Series A as a corporate investment by Gemstar. Okay. So we got to know each other way back in 2006. And after I sold Gemstar, he wanted me to join his board, and I did. He actually did a Series B with Madrona, which is the largest investor up in the Pacific Northwest. And so we've had an ongoing relationship since then, and we wound up in the same operating space. He wound up selling his business to Vizio, so he was down in Irvine a lot, and we'd invested as angels together. And so we felt that this life is about timing. And this was the right time for us to do something like this. We didn't want to do another startup. And we felt we had all this experience. We felt we were very well positioned he's a native of Seattle. I've spent a lot of time in LA. And then there was a third partner. Andy had a long-time relationship with his Razi Imam, who's our partner in the Bay Area, who was born in India, but was a Southern Cal native before spending 10 years in Seattle, and then was for the last few years in the Bay Area. So Andy had a long-time relationship with him. He had introduced us. We got to know each other, and we felt that the way we wanted to architect the fund, as if when we were raising money or for our startups, we always would have wished that if you think about it, that the fund had a presence in Seattle, in the Bay Area, and in Los Angeles. Because when you're in the early stage, you don't have extra muscle tissue in terms of traveling, et cetera. So we always would have loved to have our investors have a presence in these markets, which would have given us a lot of leverage from a BD or network perspective. And so that's how we decided to do it. And we also thought that Seattle and LA, and this is probably very germane to the folks who are watching, huge markets. And at the same time, there's not an overabundance of early stage capital. And obviously we'll always look at the barometer as the Bay Area, but especially if you think about Seattle, LA has more, I think, definitely more than Seattle in terms of early stage, but it was kind of an interesting observation that with two largest tech companies in the world sitting up there, that there was this paucity. And so given our networks and our long-term in market experience as operators, as investors, as executives, we felt that we had a really good set of relationships to leverage as we try to build out Unlock.
Good, good. No, so it sounds like three guys that have worked together, have that experience, kind of naturally get a lot of geographic coverage, both for finding deals and then, particularly in the Bay Area, it's probably good to have someone that's kind of closer to the exit maybe deals that are happening in some of that space. So that's a decent strategy. So let's learn a little bit more about the firm itself. So your website, it's a nice website and it lists your pillars. So I think these are your firm's guiding principles. So can you tell us about those, and how do those guiding principles affect your day-to-day decisions?
Yeah, I think the things that the pillars as we think, and I won't give it in any particular order, it's the notion, I think for us, it was very important to always be present. By that, I mean, we're always running around doing so many things. You have to have a conscious effort to try to be present during the conversation, whatever that conversation might be, with an investor, with a potential entrepreneur, with a portfolio CEO or a member of the team, or one of your partners. So that's important. We always think about relationships. I mean, everything, life is not transactional. It is and it isn't. And so we're very important. We definitely place relationships at the top, because we're trying to build a long-term outcome for our ecosystem, and our ecosystem is not just us. We talk about building a tribe, really, and then you've come to some of our events, right? I mean, it's not about Unlock; it's about, we're going to provide a platform and let things happen. We definitely are about leveling the playing field. I think that's super important for us, and by that I mean, we definitely think that people should, and teams and companies should be judged. We think about it as the intersection of opportunity, experience, and motivation. And those things don't need to have other filters applied to them. And so we definitely love, the notion of leveling the playing field. And we try to apply this. We spend a lot of time. It seems simple to put four things out there, but it takes a lot of time to narrow it down to that. So we did spend a lot of time thinking about what was important to us in our mission. We then try to apply it, and we'll try to course correct and look at this on an annual basis to see what needs updating when we go through that.
No, I listen, I admire that, that you're out front with the principles that you believe in. And I think it's interesting that for your first one, I mean, you said no in particular order, but you mentioned it first. And I think it's first on your website too, is be present. So it's interesting that you would use kind of a principle of high EQ to kind of as one of your first principles. And then obviously that ties into relationships as well. There's certainly a lot of stereotypes of investors who, as you said, just may not, paying more attention to their phone than maybe to the investor when they're making that pitch. So, in fact, I even give entrepreneurs some particular advice on how to overcome that. So it's interesting, and I admire you guys for having that as one of your principles. So, let's talk about the firm itself. So, can you give everyone a sense of the investment criteria? I mean, we've been talking about the firm, but let's get into some nuts and bolts on investment criteria. What types of deals you look at, what stage, et cetera.
Yes. So we're early stage technology, which means pre-seed seed for the most part. Have we done A's? Yes, we have, but that's a little bit beyond where our entry point is. So we will definitely participate in follow-ons at the A and the B, and we've done that with some of our portfolio companies. But in terms of entry point, it's pre-seed seed. On occasion, we have even done blank sheet startups where we've co-founded, but those are the exception, not the rule. Okay. We have a geographic filter, as I mentioned. We are West Coast based in the sense that we can invest in Seattle and Los Angeles, Southern California. Los Angeles is such a big area. But we also can do deals in the Bay Area, but in general, we focused on LA and Seattle. So that's the geo filter. The other part is we look, while we are sector agnostic, we look at companies or teams that have some unique insight or access to data, which can be metadata and or first party data. And then potentially, if not today, then in the relatively near future, and whether for themselves or for monetizing with third parties, can actually utilize one of the frameworks of AI to extract value from that data. So if you look at our portfolio, you can go on our website, unlockbp.com. And if you look on the portfolio, you'll see a broad cross section of companies. But one of the things you'll see is, this type of criteria in terms of the operational filter does lend itself to things like fintech, to real estate tech. And so we've done a fair bunch there, but then we've got things in D2C as well. But in general, you will see there's a thread of data running through it, and the potential for using machine learning or NLP or CV to extract value from that data.
So, just also to make sure we're clear with our audience, sometimes, from my perspective, I might see a little bit differently than yours, Sanjay. When you say sector agnostic, I think you still put the filter around technology, though. So just
industry, maybe I should say industry agnostic. So, right. Yes.
So there's, for those of you that are in the audience on the life science side, I know there's a few of you out there. So that probably particularly, straight out, FDA risk, biopharma, biological, those types of things, probably not for
yes. Life sciences, it's a different investment profile, and we're just, that is not our expertise either.
Correct. But within technology, within digital technology and data, pretty broad, and you and I have had those conversations where I've tried to pin you down, and you've completely pushed back on that. So don't put my technology sectors in a box, Luis.
Exactly. Yeah. No, yeah, I think, we've invested, and as I said, if you go on, you'll see if there was a direct-to-consumer outdoor furniture brand, there is the largest, non-Caucasian healthcare a longitudinal patient data set, and then there is a digital, sort of the mobile 529 solution in fintech. So
yeah,
a broad cross section of companies that we've invested in.
Okay. So you mentioned that longitudinal data set of non-Caucasian patients. Interesting. I know we were going to really talk about that, but you and I should connect about that, because there could be some interesting opportunities that have come up kind of post-COVID. So let's catch up on that later. Too detail oriented, too boring for our folks. But all right, so tell us about your investment process, and particularly how it starts. This is an area where you've brought a little bit of kind of structure to randomness that some founders might see with other investors, that it's just random in terms of getting connected. But you guys have brought a process to it. So tell us about how it starts and how it goes through the process.
Look, we're always, opportunity and value is everywhere, and we don't have any one formula to how we've gotten our deals. We're definitely not a volume type of investor, in the sense if, a lot of times you see people say, okay, we've seen 5,000 companies, and then we've drilled down and we've reduced it to 1,000, then we've had 300 meetings, that whole super funnel. We just don't have the capacity to go through all of that. So one of the things, we get a bunch of qualified referrals from folks in our network. The other part is, as I always try to push it out, and we have on the contact us form, we try to get all the salient metadata. Shouldn't take more than 10 to 15 minutes, and I figure 10 minutes to fill out this stuff, and then it automatically gets distributed to all the partners at the same time, as well as gets logged in our system. So it's never going to get by the wayside, because if people email, a lot of times when you email, things get crushed in an inbox. Now that I'm on this side of the table, I really have to say, for VCs, not that it's being self-serving, it is not that we're blowing stuff off or anything. The volume is just so much, and you're just running literally from, I'm not going to say fire to fire, but situation to situation. A lot of times things get buried. And so, that's what really happens. And so this is a process to try to not have things fall through the cracks. But I think what we do is, as a result of giving that, one, it shows a commitment by the entrepreneur that, hey, you want 30 minutes or 1 hour of my time. it's worth 10 minutes of your time to make sure we get the information that's more efficient. So we get things coming in where we know it's not going to be a fit, and we automatically don't waste their time, don't waste our time. We respond to that. We try to respond to everyone who submits there and let people know, hey, this doesn't fit. You're in Chicago. We don't do deals there.
Yeah.
Don't waste, let's not waste each other's time. Or you're at this stage, which is further away, or this valuation does, we'll try to cut it and separate the wheat from the chaff real quick and save everyone's time. And then thereafter, we do look at it. If it's in Seattle, Andy will take the first call, unless it's some particular area that I know. And, if it's down here, I'll take the call. If it's in the Bay Area, Rozzy takes it. And thereafter, our process. So just to do that, I mean, it sounds very simplistic. It cuts down a lot, but we go more for volume and qualified as opposed to, go for qualified as opposed to volume.
Yep.
We interact with folks. So we try to get a bit deeper on the first cut, and we always try to provide feedback, whether it's a yes or no. We usually are going to be relatively quick about it, so we can spare people cycles.
Okay. Hey, real quick, I realized something I was going to do and I forgot to. So Travis Rubidor is our technical producer, kind of behind the scenes. Hey, Travis, can you go to the Unlock Venture Partners website and grab the contact us link and throw it into the chat? That'll be helpful. We have it coming up at the end, but that'll be a little bit helpful for people that want that. Okay, so you've taken the information, qualified leads, also some of these others. You've filtered those down. You divide up the initial meetings. So tell us about kind of the what does it then take, generally speaking, to get the investment decision? How do you guys decide? Is it unanimous amongst the three of you? And then, what are some of the things you look at in the due diligence process, and how long does that take?
Yes, it's always unanimous. There are only three of us, so it's not that difficult. We talk. We have a daily stand-up. And then, just like most funds, we'll have a Monday call, which is a lot longer to determine, sort of more meaty. But we have a daily stand-up, and we still talk multiple times during a day as it comes up. So it's unanimous. And the way it works is usually there's two steps to first, which is one partner will chat and see and have the conversation, get notes, get the feel, and then it's, should I push it forward or not? Do you feel good enough about it or not to stand up for it? And thereafter, then you gotta, in general, is to meet or talk to the other two partners. We do sort of a broad full partner call, and then it's okay, we want to do this or not. In general, we're a lot more deliberate. We're not knee-jerk type folks. We'll take our time after that to get to the finish line. But we try to, when we say we're going to do it, then we're in. We do our confirmatory and all of those things. But in general, we try to do a lot of that confirmatory piece before we say, yes, we're in. There's other specific confirmatory, but a lot of the background stuff we try to do beforehand. And the good news is we have a broad cross-section of LPs who are operating LPs, who are successful technology entrepreneurs. And so we have a very diverse network of folks that we call on as we try to qualify the opportunity or the company. We do a bunch with the entrepreneurs. This is a cliche. We're not special in this. At the early stage, and this is a particular challenge, and I'm sure we'll touch on it later, is we don't go by as much operating data and metric, hardcore metric data, that a Series A or B investor would have access to. There's not as much signal as you would get later on. So a lot of what we go by is how we evaluate the entrepreneur. And let's be clear, as good as you look, Luis, with UCI in the background, a 2D image it doesn't give you for instance, I don't know, if you stand up, are you going to be wearing shorts, or, you know what I mean? You can't really get the full sense of what someone's in. We rely a lot on sort of body language and all of that individual interaction. But that said, I think that's a super important part of why we do the first meeting with one partner, and then the other partners are relying to a large extent on what the first partner is going by. But before COVID, we would always be I'd be up in Seattle, the Bay Area. They'd be down here at least once a month. So there's always the opportunity to meet in person as well before we close out. All of us.
Right. So how do you also then have those meetings with the other members of the team?
Yes.
Not your team, but the startup
Yeah,
team?
we do. We do try to do it because it's not just the founder or founders. There are other people. We definitely try to do that to understand how that dynamic works. A lot of times, I mean, you know, sometimes you can wind up where those people are not, you know, co-located in the same city, which is fine. We still try to have a conversation. We have one company where the engineering team is in Germany.
Sure.
So in that particular
Okay.
case,
So nice tie-in, I think, there to one of the questions we got, which it kind of goes to solo founders versus teams. So I think I have an opinion on this. I'd love to hear yours. So, you know, it makes sense. You hear it a lot that you invest in solid teams and that kind of teams do it. But then, you know, teams can also break up. There can be founder disagreements. So, you know, solo founders have a little bit of an advantage there as well. But so how do you value? What's your opinion on valuing, say, solo founders versus a team of founders?
vanilla chocolate. I mean, you know, those are both good, and sometimes you want one versus the other. It's so let's put it this way. In general, I always prefer to not have a solo in general.
Yes.
Very generalized. But I'm not so focused on quote unquote founder. It depends on what I would call the core leadership. You know, again, think about it. We're early stage. We're not at 50, usually 50, 60 person companies. So what is the size of the company? Like, what is the differentiation between a founder and a senior person? So I'll give you a couple of examples. I'm not dodging your question. I'm just going to give you a couple of examples where there's one company, you know, excellent CEO who's a sole founder. Now, right now, looking at the person, I go, you're amazing, you're doing a great job. But what actually convinced us to do that deal was not that the person was a solo founder and, you know, checked a lot of these. It was the fact that the team, the senior team, was so experienced in the industry. And this person had been able to recruit them so early on to be a C person or an SVP person. And that was the core team. So to me, while on the cap table, maybe you say that person is the sole founder, and there are implications around that and what you can do from a financing perspective and the advantages and disadvantages of that. But that to me was the set of founders. So I don't lay it so much on a solo founder, but you know, when things get tough or tough decisions have to be made, are you looking at one person? Yes, you should always be looking at one person, but who can that person rely on? And this is why the advantage of co-founders is there. The co-founder, especially someone who started, you know, from a blank sheet or whatever, that's the person you're going to rely on, because startups are so hard. Startups are so lonely. And if you are lonely, if you're a sole founder and therefore and you're a CEO, which in most cases it is, that's a doubly lonely position to be in. So it does require a certain type of individual to pull it off. So that's, I think I answered your question in
No,
this.
yeah, I think you did. Some...
For the health of the entrepreneur, I generally prefer that there is another founder. And yes, of course, it leads to conflict, but you can't tell me they're not people who second guess themselves as much as they would second guess a second party. So, you know, at least you have someone else to bounce it off.
Yeah, no, that's well said. All right, so you guys at Unlock, you're on your second fund. Let's talk about the first fund real quick. So can you tell us about some successes and failures in that first fund? You know, and what did you learn from either or both?
I'm not being glib or slick. There are not really failures in the first fund yet because we're still a young fund.
Nice.
Still a young fund. We had one that's that wound up, but that was, you know, I think that was a very, you know, I'll give that as an example. Actually, it's a really good example. One wind up out of 22 was an organized wind up where the person was going to get, he was going to get a Series A. He was definitely getting his bridge from the existing investors, including us. But the team decided, primarily the founder decided, that he didn't have enough product market fit to justify spending another 3 years and several million more dollars going down that path. And so he said he returned. There was still money left. He wound up return. We got some percentage of our money back, and that was it. And I thought that was incredibly smart, incredibly professional, but very realistic to say, the opportunity cost for my life in 3 years, it was just not there. It was talk about intentionality. It also, there's intentionality that you need to continuously maintain as you think through, hey, sometimes you need to do irrational things to have outsized outcomes.
Okay.
But I think, I think that was a very intentional thing. So I point that out as a great example for how one should evaluate where you are in a very realistic manner. But some of the successes, I'll touch on a couple. Let's stay, over here. We'll touch on a couple here, and I'm happy to talk about. We have some great companies and outcomes in Seattle, but I think locally in Costa Mesa, there's a company. The first Orange County deal that we did was Fight Camp.
Okay.
And that's an in-home. It's a boxing equivalent of Peloton, in-home fitness. As you can imagine, the space is incredibly hot right now with the success of companies like, Tonal, Mirror got acquired by Lululemon, Peloton's public. And so that's been a great outcome for us. We love the team, fantastic. And they actually have a full-fledged, you've been there, full-fledged gym, boxing gym and studio where they shoot video in Costa Mesa. And, they've done really well. That is one where they have hardware as well as an ongoing subscription model.
And that was fund one or fund? That's fund two, right?
Fund one. That's fund one.
Fund one. Oh,
and
okay.
Stay tuned. There's some great news coming from them. And they've done, I think their performance during COVID has been great, but even before that, they were doing really well. And so that's one. The other one is one, Vilux. That's the product Luma is just concluding a test on an Indiegogo, and that one is I know I didn't realize some of the backstory there with you, but we've known Matt McRae a long time, and the backstory there is actually Matt was and you talk about networks and how things get done to a certain extent. I mean, Matt's is the chairman there, and a founder, but Matt was Andy's boss at Vizio. He was there when Vizio acquired Buddy TV. So there's a relationship from way back. And then interestingly enough, Sean, who is the CEO, we had been approached with the prior company Sean was doing.
Yep.
And we looked at it seriously, but we ultimately decided we didn't want to, we just didn't want to proceed because the cap table was more complicated than we would have liked. And so, but we knew Sean, we liked Sean. And then, fast forward some months. I mean, we actually met Sean at CES, where we looked at the virus. So that's in February. And I fast forward, and here we did a deal for Vilux. That was the last deal out of Fund One. And so, it's early days, but the product, if you haven't checked it out, the product is really slick. It's basically using UVC light to effectively sanitize multiple things like your watch, your phone, your cars. When you come in the house, it looks like a very nice clear-faced microwave.
Right.
Put your objects in 1 minute, and that's it. And it's not just COVID; it's a whole bunch of other things that viruses or germs that it can disinfect your objects, disinfect those objects that you place in it.
Yeah, so Matt McRae, who we're talking about as the founder, his wife is also on the faculty at UC Irvine. And so this is very direct experience from being in the clinic and just looking around saying, all of these things that are sitting around, from phones to things that they use in the clinic, could be potential transmission sources for viruses and bacteria and things. So wouldn't it be nice to have a device that could, kind of zap with UV light and put this out there? And with Matt's experience at both Vizio and Arlo, which he's currently the CEO of that Arlo publicly traded company in the consumer electronics space, it just seems like that was kind of a natural. So yeah, we were thrilled to be involved. We were kind of, I believe we're one of, everybody can claim when it's great, everyone claims a part at the end. So I think Matt reached out to Richard Sudik and I pretty early. And I was the one who actually gave Sean the heads up that Matt had this new startup and Sean should check it out. So that's kind of how they brought them together. They're part of Wayfinder. I'll point up to the Cove here. So they're doing great. So yeah, check out Violux on a shameless plug here. Check out Violux on Indiegogo, and they're already sold out of their first ones. They've exceeded their goal. But yeah, they're going to have some products in the marketplace this winter that I think are absolutely going to be of some benefit for users out there. So
we've got a couple in Seattle. I definitely want to talk about Seattle a little bit because, we've got a couple of companies up there, and we love all our children. And we're just talking about a couple that happen to be topical.
Right.
Lest anyone should look at this and take umbrage, but Possible Finance is one where it's providing financial solutions to the underbanked. Phenomenal team. They've done a great job of taking something from a blank sheet of paper, fast forward, in less than 2.5 years to get to where they've gotten. It has been incredible. And they're already at the Series B level. And that's one where we actually work with the entrepreneurs from that blank sheet of paper, ideated and got that company off the ground and been supportive throughout. But it's been a great thing. I think, it means it shows you can make money and do at the same time do good things. So they're helping the underbanked build credit at the same time as providing them with very quick liquidity as people need it, which a lot of people do in this time. And so we're very, very happy to be partnered with Tony and the team there. And the other one is Dolly, which is, think about it as an Uber for oversized product, bulky items. And that again is a great story, repeat entrepreneur in that case, where, very gritty. Every company always has there's always existential moments, and they've been doing really well regardless of COVID.
Yeah.
It's been great. So those are two companies that we have very good, very high hopes for.
Hey, is Dolly down in Southern California yet?
It is. Okay. It is.
And how do you spell it? You can probably
Just
spell
like,
Dolly a gazillion different ways.
Dolly, yeah, you're right. These days there are letters missing, etc. No, it's Dolly the traditional way, Dolly, and it's just like the dolly that you use to move items around. So yeah, it's a mobile solution. You can get it on iOS, and
yeah,
I've used it a few times. It's what I like about it, especially, and this is not a shameless plug, it's just the notion of how some things are so obvious. Of course, operationally very complex. They're in multiple cities now. They're in the NFL cities, but it's the notion of they have the ability for you to select a 30-minute delivery window. I mean, so your eyes are going up saying, "Whoa, that's big." I mean, in this day and age, when we assume everything is readily available, to not have that as stable, as an option is eye-opening in a sense. But yes, that is one of the things that I really like about it.
Cool. All right, let's dive into some advice for founders and startups and things. So yep. What are you hearing right now, kind of at the board meetings that you're in? Obviously, nothing, non-confidential. What are you hearing about customer pipelines right now? So how are your portfolio companies doing right now with their customer pipelines? Are pipelines building back up? Are they recovered? Are they strong? Are they challenging?
I think if you asked that question 3-4 months ago, you would say, "Oh, it's tough." The stuff that we talked about in April and May is something that's manifested right now, which is, especially with enterprise SaaS, et cetera, everything's slowed down. When you look at it now, we're, 6 months in? People have to start doing work. I mean, you can't just sit on it the whole time. So I think it's a little bit of a mixed bag. There's still, things take time, because if you think about it, look at people managing balance sheets and P&Ls. people still have issues on, people have got to tighten on the cost side. So from the question, from the situation with the pipeline, things are taking longer, but I don't know whether it's anecdotal or sector wise. There are things that have loosened up and things that are still taking long. It's not, I haven't heard that, the big true enterprise cycles have been massively affected, because those things anyway had long life cycles. Things might be off a little bit. For instance, we're dealing with one in pharma, and pharma, there hasn't been an impact in the normal sales pipeline in terms of timeline. But at the same time, if you think about things that are, medium price ticket items or small price ticket items, some of those are going, having not as much challenge on an individual basis, but an aggregate, it seems like all of it has slowed down relative to where we were, but not as bad as it was 3 months ago.
Right.
Now,
right. Okay.
what that means, if this quote unquote second wave feels persistent, or my take, and again, this is just my take, is not based on empirical evidence. I think people are waiting for November. And that naturally plays in, okay, November, Thanksgiving, I'll see what happens with how long this election is going to take to get resolved. Oh, it falls into Thanksgiving, therefore I'm in Christmas. It's a very, to me, the critical period right now, which is what we've been telling our portfolio companies, this, for the next, call it 3 weeks, try to get as much, 3 to 4 weeks, try to get as much as you can get done. Because, I think you're going to hit the traditional, slowdown period a little bit earlier in my mind.
Yeah.
But having said that, I do believe coming out of this in the new year, I think people have got to realize you can't just, whether it's investors or companies, you can't just sit on your hands. How are you going to justify your paycheck as well?
Yeah, no, I agree with that. I think the plans that are being made right now for 2021 operating plans, are going to start with the default. All right, we're all remote, so therefore, what are our plans going to be remote, and what are we going to still do in 2020? Because you're right, people need to effectively get the job done. So a couple other quick questions. Where the chat Q&A is kind of building up a little bit, so I want to make sure we leave some time for that. But there's one I really wanted to kind of hit you up on. So you guys are pre-seed and seed, so you're in pretty early, but odds are you're not first money in. Sometimes maybe, but oftentimes not. So that's often where some founders get stuck. That first 50,000, 200,000 to build a minimum viable product, et cetera. So do you have any lessons or insight from your portfolio? Kind of what types of investors, what types of people are on the cap table when you guys come in? What can you share about that?
Well, usually it's the F&F. Usually it's F&F and then angels. And then maybe you've gotten some, smaller, smaller institutional funds who've written checks into it. That's usually on the cap table. By the time we get involved, sometimes we've been first institutional money, and other times, there's been other institutional money already there. But I think if I'm following the sort of the trail, what you're saying is, what you're asking me, what are we also looking at? I will tell you this. Sometimes people are like, oh, how do I get the first money? And I go, look, in this day and age, this is not 1998. You're talking about the massive leverage, depending on what your business is, of course. Think about the massive leverage you have operationally from things like cloud services like AWS and Google. You don't need the CapEx required from the server perspective. You've got iOS and Android, depending on what kind of solution you're putting out there. Think about the leverage and distribution those things get. So from the point of view of an investor, and then there's all of these ability to do development across the world if you're worried about cost. So as an investor, if one of the things you go, oh, I just need 50 grand, 100 grand. And look, there's nothing, depending on, it's always going to be, depending on who you're banking on and what your past is, you can get that money from institutional people, right? People who have exited, created exits for other companies or funds, they're going to get the money the next time around. They're going to get the benefit of the doubt because of their track record. If you don't have that, one of the things, and was said to me when I was on the other side of the table raising, right? I put my own money in, but a lot of things, the feedback is they go, well, if you can't convince your F and F to give you money, why do you think I should give you money? I'm not saying this is the way we necessarily always think about it, but that is think about a signal where, think about signal in case A versus case B. Case A, entrepreneurs like, I mortgaged my house. I'm giving you an extreme example. I put in a couple of $100,000. I've got F and F for another 200, 300 grand. I raised 500 grand. This is what we got done, all of these things. And here we are. I've got a little bit of, I've got some data because we did a test. We used SEM buy. We got this test and our CAC is looking like $15. This is where we are. We've done this across 1,000 customers. Okay, it's case one. Case two, this is a great idea. Look, show me slideware. And this is how I'm going to get from point A to point B. No, I haven't put any money in, but I put in, 6 months of sweat equity. And I want XYZ. No, I don't have a product built. I want to build a product. Think about the risk profile they present. And I'm not saying that case B won't get the money, but just think about it if it was just all things being equal, which they never are. How are you going to look at that? So I think it's imperative that you have skin in the game and convince people within your network to give you that early money. And obviously, if you have Angel X, who has a great reputation, that's a great signal. Angel X has a network as well, and then people upstream rely on Angel X's sort of track record and filters to say, okay, if you said it's good, I'll take a look at it.
Yep. Just for the few people in our group who may not know the acronym, so F&F, friends and family. And no, that's cool. And then the other one I think you used out there, slideware. So, another version of, someone who has a nice slide deck and a presentation, maybe a PowerPoint, but doesn't have, say, a minimum viable product. Although I had someone once tell me that a minimum viable product could be even a slide deck, but we'll say that's for later. Hey, we've got some good questions building up or in the chat. So why don't we knock off a few of these and then we'll kind of go from there. So Sashin wants to know about the system that you guys have for submitting proposals. It sounds like he's saying you don't use that for ongoing communication, right? That's just inbound one-time live, right?
Really, it's we automatically get it logged in on Airtable, and that's a tracking mechanism, so nothing falls through the wayside. Right. It's a way for us to also, for us to see what when you look at it in aggregate, look for things so we can improve our process. Okay. We have our own scoring solution as well. As we evaluate teams and CEOs and entrepreneurs, we have our own system, an initial filter and then a longer form filter to try to track. And then we backtest against it to see where we were off, where we were wrong. This is still a work in process. We're not trying to automate the process. I will tell you that. We still rely a lot on our intuition, but it's important because each of us sees different things. And rather than it be just a qualitative discussion, we try to put some quantitative behind it.
Yeah.
Does that answer Sachin's question?
No, I think it does. Yeah, I think it was primarily whether you're using that for ongoing communication. But it's interesting what you say about logging, kind of quantitatively logging what you have seen, so you can learn something from that.
Yeah,
I think that's
absolutely.
That's going to be, you're gathering data. Frankly, what you want your portfolio companies to do, right? You're generating data. You want to gather that. So Sonny wants to know. He says that he noticed that UNest is in your portfolio company, and it's an Anderson company. So who knows? Maybe Sonny's with Anderson. He wants to give them a plug. But do you work with accelerators like the Anderson Venture Accelerator and others? I imagine so.
Yeah, we work with everyone. I'm actually on the Price Center board at Anderson. So I spent a lot of time at UCLA, just given my background. But no, we're not officially partnered with accelerators. But yes, we absolutely look at it. I actually met Ksenia, the CEO, at the Accelerator Showcase, which I'll give a plug for UCLA, is the next Accelerator Showcase is on Wednesday. But I met her there. That's not when we did the deal. I heard her pitch there when I got reconnected with her later on when she was to the tail end of her seed round. And that's when we were like, oh yeah, I remember. And so we had the chat. So no, it was not that I had tracked her, but yes, I do spend some time, obviously not right now, but yes, I do spend time there, but no, there's not official we have relationships with a whole bunch of folks. And if you have any folks that you want us to connect with, happy to do that.
Yeah. Yeah.
And for that, you can just send me an email.
So Anil found the one thing I think was on my list, and I skipped it, and so did you.
Yeah.
What's the typical size of your investments?
For the first fund, it was 500 to 750. Right now, we're targeting between 750 and 1.25. We try to cross ref that with ownership. We try to get to double-digit ownership in the most case, and so it just depends on stage. We just had a deal the other day where they didn't want to take as much money, but they accommodated, so it was lower than the 750, but we got to our number.
Yeah. So Bruce is asking about saying, his experience is you've got to have this existing relationship to get funded by a fund. Just when at the end of it, when you look at the number of deals that got funded, which ones had existing relationships, et cetera. And it kind of ties into what you and I glanced at this morning in PitchBook. So one of PitchBook just put out a report that said first financings as a percentage of total financings are way down, meaning that there's a lot of follow-on financing going on. So the numbers have held up well in the pandemic, but first financings are down, maybe they said as a percentage, maybe half of what they were kind of a year ago. So it does speak to that problem. And listen, I don't know if you have the problem. I don't think anybody has the answer to this. Is at some point, you're gonna have to start or making investments in people who you haven't met face to face and you didn't have that existing relationship with. So I don't know, what have you and your partner said about that? Or have you done an investment that's been entirely Zoom?
Yes, we have done.
Cool.
One that was entirely Zoom, but in that case, we did rely on. It came to us through to other investors who we know well. One of the investors we know. We're in another deal together, which actually they referred us to as well. So there was a level of trust. My point is that gets you in the door. That doesn't get the deal done.
Yeah.
But ultimately, we have to like the deal. But then after that, you're going to rely on, apart from your own eye test, you're going to rely on people that you know. And in general, think about it this way. The other investors that you work with, in general, people are not transactional, because if you screw me now, we're supposed to be in business and potentially going to be doing business together for years. So in general, people tend not to yes, you obviously push these things, but you don't, you're going to be straight up about it, because next week there's another deal to talk about. And so you do rely on those relationships. The short answer is, no, you don't have to have an existing relationship with someone at the fund. But will it help? Of course it does. Any relationship, but you're usually going to have the entry with someone who has a good relationship with that person at the fund. You, as the entrepreneur, don't have to have it. But for instance, don't just think it's like, oh, I've got to go to this. A lot of times you got to lean on your attorney. If you have counsel deals with funds, and you have to figure out what are the right counsel. Counsel usually will take you to a bunch of funds, because that's, that is what they do, and they have those relationships. So I think that's one entry point. But apart from that, in this time you can't do it, but use your network. You will be surprised who can connect you with folks. It's not that LA is that big a city.
Right. No, and I think it's interesting that you pointed out something that I try to share with founders too, is that for the most part, VCs and investors, this is a long game, right? I mean, you've got long life funds, and so you've got to protect those relationships over time. So that means that by and large, you're motivated to do the right things in referrals. You're motivated to do the right things when you deal with your portfolio companies, when you deal with founders, when you deal with those that you didn't, because a bad reputation on your side is gonna could last, and that's can be detrimental.
Absolutely.
Well, listen, I think that's a good place to probably end it right now. We got a handful of questions that maybe Sanjay and I will grab afterwards. But for now, I will bring this one back up, and want to make sure that we thank our sponsors again, Kenobi Martins. where you'll find a unique intersection of technical intelligence and legal acumen for a world powered by innovation. And we put the contact us form there for Sanjay, and so you can go there and fill out the form, and you'll get a response, as he said. And my contact information is on there as well. So I also wanted to let everybody know that our VC speaker series is moving to a once-a-month cadence. So please watch your emails. We don't have a registration link for you for November's, but watch your emails and the event calendar at innovation.uci.edu, and you'll get the announcement for our November speaker series that we have. And I'd also like to thank our technical producer, Travis Rubidoux. He was on the spot there getting us that link earlier. I appreciate that. And he works at UCI Applied Innovation, and he's a great help getting these webinars out. So, and if you're one of those people that still have a question there in the Q&A, Sanjay and I, after we go off video, we'll try to answer a couple of those. And but that's the end of today's webinar. So thank you everyone for watching. Stay safe and have a great weekend. Bye-bye.